Cash flow statements are an essential tool for understanding the movement of funds within a business. But have you ever wondered about the key differences between the indirect and direct methods of preparing these statements? Understanding these methods is crucial for financial analysis and decision making. In this video, we'll explore the indirect method in detail, uncovering its unique approach to calculating cash flow from operating activities. Join me as we unravel the intricacies of the indirect method, step by step, and discover how it compares to the direct method. So let's dive in and unlock the secrets of cash flow statements. Unlock the secret to financial success with Kountin Koins, where numbers come alive and your accounting game thrives. We are diving headfirst into the complexities of the indirect method of preparing a cash flow statement. But before we jump into the intricacies of this method, let's take a moment to fully understand the key difference between the indirect and direct methods. Trust me, it's an important distinction that will pave the way for a better understanding of cash flow statements as a whole. As you may already know, the cash flow statement is one of the three fundamental financial statements, along with the income statement and balance sheet. Its primary purpose is to provide a comprehensive overview of how the cash balance in the balance sheet has changed over a specific period of time, typically a quarter or a year. The cash flow statement categorizes cash inflows and outflows into three main sections: cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. Now here's where things get interesting: the indirect and direct methods. The primary distinction lies in how these methods handle the cash flow from operating activities. While the sections for cash flow from investing activities and cash flow from financing activities remain consistent regardless of the method used, it is the cash flow from operating activities that differentiates the two. So, what exactly is indirect method? Well, it all begins with the net profit or loss derived from the income statement. The indirect method involves adjusting the net profit figure to account for non-cash transactions until we arrive at the net cash inflow or outflow. It's worth noting that many large companies adhere to the accrual basis of accounting, where revenue is recognized when earned and expenses are recorded when incurred, not necessarily when cash is received or paid out. To calculate cash flow from operating activities using the indirect method, we follow a well-defined three-step process. It's time to roll up our sleeves and get into the details. Step 1. To start off, we jot down the net profit figure as our initial point for making adjustments and arriving at the net cash flow. This net profit figure can be easily found at the bottom of the income statement. Let's take an example. Consider the fictional company Sunshine Enterprises. They have generated a net profit of $70,000 for the year. We'll note down this amount at the top of our calculation as our starting point for further adjustments and determining the net cash flow. Moving on to step 2, it's time to add back the non-cash expenses that are presented in the income statement. Our goal is to reverse these expenses from the net profit in order to get a clearer picture of the cash flow. To accomplish this, we carefully review the income statement and identify any items such as depreciation, amortization, or gains or losses on the disposal of non-current assets. Let's say we find depreciation expenses of $23,000 in this particular case. To account for depreciation, we add back $23,000 to our calculation, ensuring we make the necessary adjustment. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Now let's move on to step 3, where we adjust for the movement in working capital. Working capital is determined by subtracting current liabilities from current assets. Let's take a look at the balance sheet to identify our current assets. We observe cash, accounts receivable, and inventory. However, since we are reconciling back to cash in the cash flow statement, we can exclude it from our calculation. The same applies to non-current assets such as plant, property, and equipment as they impact cash flow from investing activities. This leaves us with inventory and accounts receivable to consider. After reviewing the balance sheet, we find that the closing balance of inventory is $94, while the opening balance is $68. This indicates an increase in inventory of $26. Increases in inventory are deducted when calculating cash flow from operating activities because they represent cash spent on purchasing raw materials or manufacturing goods. Therefore, we enter a negative value of $26 in our calculation. Moving on to accounts receivable, we observe a closing balance of $120 and an opening balance of $98. This signifies an increase of $22 during the year. Increases in accounts receivable need to be deducted from the net profit when calculating cash flow from operating activities because higher receivables indicate that less cash has been collected from customers. Hence, we enter a negative value of $22 into our calculation. Moreover, we must also account for the movement in current liabilities to ensure a complete consideration of working capital. Taking another look at the balance sheet, we identify current liabilities such as accounts payable, salaries payable, interest payable, and income tax payable. We can ignore long-term borrowings, share capital, and retained earnings as they relate to financing activities and equity. So we focus on these four current liabilities. The sum of their closing balances is $156, while the sum of their opening balances is $131. By calculating the difference between these two numbers, we find that payables have increased by $25,000 during the year. Increases in payables should be added to the net profit in order to accurately calculate cash flow. This adjustment makes sense because if a business delays paying its invoices, it can retain more cash. Therefore, we add $25,000 back into our calculations. And there you have it. With steps 1, 2, and 3 completed, all that's left is to sum up these adjusted values. The result is a net cash inflow from operating activities of $70,000. Not too shabby, right? We arrived at this figure using the indirect method. However, a quick check using the direct method yields the same result: $70,000 of cash inflow from operating activities. Both techniques lead us to the exact same answer, ensuring the accuracy of our calculations. Now, you might be wondering which method, indirect or direct, is better. Well, the answer isn't as straightforward as you might think. It often comes down to personal preference and the specific context in which you're operating. The indirect method is generally quicker and more commonly used by large companies that follow the accrual basis of accounting. This method saves time for accountants and bookkeepers, which could be a significant advantage. On the other hand, the direct method offers a more intuitive layout that closely mirrors the cash basis income statement. This layout makes it easier for investors and other stakeholders to quickly extract valuable information and gain insights into the company's cash flow. And here's more. Before we wrap up, it's essential to note that in this video, we have focused solely on cash flow from operating activities. We haven't delved into the intricacies of cash flow from investing activities or cash flow from financing activities. However, don't fret. Those sections remain the same regardless of the method used. Understanding the indirect method of preparing cash flow statements is vital for anyone involved in financial analysis and decision-making. We've explored the three-step process involved in calculating cash flow from operating activities using this method, starting with the net profit or loss and adjusting for non-cash expenses and changes in working capital. While the indirect method may be favored by large companies following the accrual basis of accounting, the direct method offers a more intuitive layout for stakeholders. Both methods have their advantages, and it's important to choose the approach that best suits your needs. By mastering these methods, you'll have a powerful tool at your disposal for assessing a company's cash flow and making informed financial decisions. So keep exploring, keep learning, and stay curious in the world of accounting. Which method do you find more intuitive? The indirect method or the direct method? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Kountin Koins. Happy accounting!